Welcome back, traders. It's John. It's time for a general market update. It's August 4th, 2023. Reminder, this is by Rain King LLC, and I'm an amateur individual growth stock investor, not affiliated with IBD or MarketSmith. So here's our agenda. Lots to talk about. We'll talk about some context. We'll get into breadth, talk about indicators, and then we'll get into the leader action, particularly this week. And then we'll talk about the importance of new merchandise in the market and then wrap up. So the context. Shared this last week. This is just an update. This is a NASDAQ weekly chart. And we talked about being about 11, 12 weeks from the beginning of this move. And we talked about the potential for a pullback. And you've noticed this week looks like it's going to be a distribution week. But given the run-up and the persistent run-up, this is all normal action. We also referenced two other periods as a guide. In 2009, when we had our first pullback, around week number 12, it was 8% for 4 weeks. And in 2003, coming off the bear market bottom, we had a pullback of 7.6% in 4 weeks. So it gives us a little bit of reference points to consider what's normal in a pullback. And it's good to have these in our back pocket. I mentioned a little bit about seasonality the last couple of weeks, just to want to remind people that we're in August. These are some of the historical returns in August and September. It's seasonally a weak period, so it's just something to be aware of, that the treading might be a little bit tougher than it had been in June and July. Now, this is an interesting chart that from All Star Charts. This overlays the S&P 500, this dark line, historically in a pre-election cycle year. And you can see the red is 2023. So you can see generally what the chart is showing us between January and June, July, is typically an uptrend during pre-election cycle years. And that has followed form by the red line showing that's exactly what's pretty much happened this year. Now, you'll notice that the trend goes essentially sideways. As we talked about, August and September are seasonally weak, and this shows that pretty much sideways most of the rest of the year until you get into about November, December, where we'll turn up again. So it's just something to put the back of your mind. Here is the table of all the conditions and data. You'll notice that post-World War II, the mean gain in the remaining part of the year was 5%, the median 7.6%. And the S&P being positive 93% of the time. So this is something to keep in the back of our mind. It might be temper our expectations for August through October, but overall, we're going to follow price and volume. So let's look at the S&P a little closer. So this is as of 11:30 Eastern on Friday. You'll notice over the last 2 to 3 weeks, we've had some distribution. We've had 4 distribution days, which I've plotted here on the S&P. And essentially, the S&P has basically gone sideways, if you use this red line, for the last 3 weeks. While the 50-day moving average is kind of catching up to the index is going sideways. That's all still very, very normal. We're not seeing some harsh follow-through on sell-offs. We do have the distribution day marked, but believe it or not, Wednesday, this day here, was actually the first S&P daily loss greater than 1% in over 2 months. Very persistent uptrend. You'll note also on the chart here, we still have net new highs on the new highs, new low indicator, which is still positive as we're pulling back in. So it's still very constructive, and some distribution is normal on the way up. You can't go up every day without some profit taking along the way. Now, this is a look at the NASDAQ as a line chart. This orange line is the NASDAQ. The dark green line at the bottom is the VXN, which is the volatility index for the NASDAQ composite. You'll notice trying to show here that the VIX was coming down in April and May. And you can see here, when the NASDAQ cleared resistance and the uptrend started to really gain some steam, the VIX was still declining, had a little bit of a spike, but then has been, since June, this entire uptrend for the last 2 months has had a very benign volatility in the NASDAQ composite. You'll notice that we've spiked up a little bit this week. And this pullback that we're starting to experience is starting to raise a little bit of fear levels by put buying and volatility. We had interest rates in the 10-year spiking this week. We've had much softer guidance as part of earnings reaction, and we had the U.S. debt downgrade earlier in the week. So there's definitely a pickup in some volatility. Just to be aware, the NASDAQ seems to be, could be more volatile than the S&P. Showed this last week about two of the big cap names in the market approaching psychological price levels. NVIDIA on the left, you can see we ran into the $500 level. I broke that down of how, it hasn't had a base in a long move. So it would not be surprising or abnormal at all for it to kind of consolidate for a few weeks, maybe form a base. Now, Apple, we use the valuation psychological level 3 trillion, which is the stock price of 194. Stock topped going into approximately that level back in 2021. And we talked about how we were doodling around with that level right now. And Apple had its earnings last night. It's had a gap down. So it's very possible that this level is going to create a pause or maybe a base in Apple as we were anticipating. So it's something to be aware of. Breadth. This is the S&P, a percentage of stocks above their 200-day moving average. We were really strong. Last week, we were around 75%, very good number. We've backed off a little bit this week as we pull in, but it still looks very healthy and normal. Now, on the right is the percentage of S&P stocks above their 50-day moving average, which really started to run hot. We actually peaked up around a level of 90% of S&P stocks were above their 50-day moving average, and it's come off rather sharply with the pullback down to 66%, where we're sitting right at the 50-day moving average. So we'll have to see how this plays out. If this was support, it was support back in late June when we had a very mild pullback. So again, nothing seems that abnormal at this stage. So indicators. There's with new software and programs out there, there's millions of indicators that you can combine and look at. My opinion is, more indicators are not better just because they're available to you. You'll get overload of too many indicators. You'll find that sometimes one indicator will conflict with another, and it will just essentially confuse you. You won't know how to read the market because one indicator says be bullish, one says to be bearish, and it really can be confusing. My advice is you need to find a series of indicators that has been proven through the market cycle, a bull-bear cycle. And they're indicators, it's okay to have a few. Keep it small, but make sure you trust the ones you keep. If you've followed me at all the last 2 years with these general market updates, it's pretty clear what I use. I use price and volume as my first indicator. I look carefully at new highs and new lows. I look at the percentage of stocks above their 200-day moving average. I look at the advanced decline line, and then I look at sectors. I look at sectors for relative strength, where the leadership is coming from, and then I put even here sentiment as a secondary indicator. And I even shrunk the text to stress that sentiment really is a secondary or tertiary indicator, but I do look at it to try and get a sense of what the psychology of the groups are. So that's what I use. And this was able to help us because when you follow your indicators and you trust them, it helped me and hopefully helped you flag the bottom in October. And we're going to look at that. And then it also told us in May and June that it was time to start engaging on the long side. So this is a slide from my October 8th general market update. And if you want to go back to that video, please watch it to get into the detail. But essentially what we were noticing was the divergence. We had new lows from really some climax selling that was going on in June. But when we came back in October, the new lows started to dry up, even though the index made a new low. So that divergence was telling us that possibly we were getting near the bottom. And then a few weeks ago, I've been sharing this chart of new highs and new lows, and particularly was emphasizing that The new highs had really picked up, but that was only part of it. The part that really was important was the new lows were shrinking dramatically, which were allowing us to see an acceleration of net new highs. We exceeded the January level and back up to the November 21 level. So this was telling us back in June that the market could be ready to make a move. So indicators that you've tested over a bull bear cycle to keep you on the right side of the market. You have to find what works best for you. I've shared what I use. And the most important thing is, avoid the TV and the news. Avoid the talking heads. They tend to be always bearish, predicting gloom and doom because it sells more on TV. It's more dramatic and it creates fear. Now, the old adage, don't fight the Fed. Well, we all know that the hawkish Fed is still raising interest rates. They just did it about a week ago, and they may or may not do it again in September. The other adage that's out there is sell in May and go away. If you were rigid and blindly attached to these two market adages, you would have missed the rally, the 2-month rally. So that's what I'm trying to emphasize is go with your indicators if you trust them, and you'll be on the right side of the market. You don't want to miss a rally when it comes. So now let's get into the leaders and some of the action of the leading stocks. Before we jump into that, let's look at earnings reactions. Last week, I shared the group on top. And this week, we've had a whole batch of growth stocks that are noteworthy. Now, you'll notice that in black means the stock had an earnings surprise. And then we have the reaction. So you can see last week, we've had 2/3 of them red, meaning gap down, not positive action. Here's the group from this week. And you can see again, if you squint, it's pretty much maybe 50-50 or a little bit more red than green. There were a couple of really good reactions. SYM, VRT, Amazon today has had a great reaction, a gap up, but still a lot of gap downs, even with earnings surprise. So it's becoming apparent that the guidance is becoming more important to the street, maybe even more important than earnings surprise. They want to know if the company is seeing momentum carry forward, and that's maybe why we're seeing gap down if the guidance is tepid. We have a lot of earnings coming up in the next 2 weeks. Here's a batch of them that I think are really important to watch because of the type of growth stocks that myself and other growth traders are paying attention to. So let's get into the leaders. And I've shared how I use this chart, this table. This was last week, the action of the leaders sorted by their percent off their 52-week high. And we look at the AD rating and the relative strength line. Here's the same chart today. Excuse me, not today. It was last night when I did this. And you can see if you just squint, you're going to see a little bit more red in the chart, and you're going to see a little bit more orange in the chart, which are more the cautionary signs. Now, you'll also notice that there are more noticeably stocks that are off their highs by 10% or more. When you get off your highs by more than 15%, you're really looking at a new base is probably likely to be needed in order for that stock to reset itself and reemerge. So it's gotten a little weaker, but it's also becoming clearer to see the stocks that are holding up the best. Now, on Wednesday, that really nasty down day, a lot of stocks, a lot of leaders got hit hard. And what I look for when they get hard is I want to see the leading stocks recover at least 50% of that drop within 1 to 3 days. If they can't recover at least 50%, it's a real warning sign that things may be changing. So today is only the second day, so we'll have to see how today closes and Monday is closed, and then take the temperature and see which of these leaders are recovering or are we seeing more deterioration. So here's the same analysis using the young guns. These are stocks that have had IPOs in the last 3 to 5 years that have leadership characteristics. Again, you'll notice that this group also shows a little bit more red, a little more orange on it. So I would use the same rule of thumb when looking at some of the stocks that took some nasty hits to see if they can bounce and recover fairly quickly. Let's go into now talking about new merchandise. Now, new merchandise, new names is really important to maintain a new bull market. So a couple things we can do when looking at some of the younger names is we can look at, this is the Renaissance IPO ETF, which is a good barometer of the IPO market, which has really been dead for the last 15, 16 months. The other thing we can look at the ARK Innovation Fund, we can look at the IBD 50 ETF, and we can look at the S&P's ETF for small cap growth stocks. They'll also give us an indication if money's flowing into small caps, meaning also some IPOs. Now, the IPO index here has moved up 50% in 2023. It's a good sign. We haven't seen this kind of move sustained for a long time. So that's important. There's a lot of new merchandise that's starting to emerge. I've just made a list here. I'm sure you can come up with some other ticker symbols, but these are, I think, our stocks that are showing some good earnings and sales and some good price and volume action. You might want to look into those. Now, I want to go one step further, looking at the importance of market themes and these new names and young guns. So this is actually data that came from Bloomberg Intelligence and O'Neill Global Advisors. And it came from an article which was looking at the opportunities in small caps and mid caps going forward. So the first theme is one we're all familiar with: artificial intelligence and data analytics. Infrastructure, hardware, and server is projected to have a CAGR of 30%, and when they're going to reach a market growth to $600 billion by 2032. Data analytics and database software is going to have a CAGR of 69% and a huge growth till 2032. And the stock ideas recommended in the O'Neill Global Advisor article, you can see all the tickers here. I've highlighted in red the names that are new young guns that have only been public for, they've come public in the last 2, 3, 5 years. So these could be potential winners. Keep your eye on them. Couple other themes: robotics and automation. Automation of factories, semiconductor manufacturing, and warehousing is becoming much more dependent on robotics. Article mentioned a whole bunch of names: Rockwell and others, SYM being one of the young guns that seems to be doing very well in the market as an IPO. Semiconductor theme for EV cars. Ideas that were mentioned were ON Semiconductor and others, and two of them were young guns. AEHR and ALGM are relatively new IPOs. Infrastructure is also another big theme. Global infrastructure, which is big time construction, electric equipment, autos, batteries, semiconductors. Lots of stock ideas were mentioned in there. You may want to check out these symbols. And US infrastructure, with the big infrastructure bill that was passed for roads, bridges, electrification, renewable energy, energy efficient heat pumps as an energy source, and some other stock ideas that were mentioned in the article. So these are a source of new ideas, and in particular, look at some of these ones in red as the new young guns of new merchandise. So a summary: the pullback is in motion. The first caution sign, I think, of the pullback was the Microsoft earnings, where they sold off. And then Meta came out with theirs, and they had an earnings gap up, and that also was sold off. That was a sign that maybe some of the momentum was coming out of the market. But as we shared early in this video, we do have some guides, 2003 and 2009 coming out of these bear markets, and what we could expect. 7 to 8% in 4 weeks would be roughly very guide for us, and it would be very normal action if we have to the 2-month persistent run-up. Now, the earnings reaction has been very mixed to poor so far for growth stocks. So it's still telling us there's some riskiness in some of these earnings reports. There's uncertainty, and you really need a cushion going into earnings. For me personally, I need to have a 10% cushion, particularly if the name is a volatile name. So you need to have a plan and be patient. You know, as we're going to pull back, you really have to have your plan of which stocks you're going to try and hold for a bigger move, and which one you might want to take small profits to cushion your account for the pullback. As always, I mentioned, stock the leading stocks. Don't take tier 3 and tier 2 stocks. if you can find a way to get in the tier 1, the best leaders. Exposure levels, you should be dialing it back this week. You've probably taken some small losses along the way or taken small profits to cushion your portfolio. I think exposure levels are appropriate in the 50% range. That could be adjusted depending on how aggressive you are. So the Boston IBD meetup, as I mentioned last week, is going to have their next meeting on August 15th. So this is going to be set up as a Twitterer follow Chalk Talk. As I mentioned, we're taking submissions of people's trade entries and exits, and we're going to give people feedback. Great way to get some feedback. So it's August 15th, 7 to 9 p.m. Eastern Time. You must register, and it will be recorded. So if you want the recording, you have to register. So if you want the link, these two Twitter handles have tweeted out the registration link, so you can get it there. You need to be a follower of us both. And those of you that are Boston IBD Meetup members, you were emailed the link already. Anybody who wants to become a Boston Meetup member, just go to meetup.com, search Boston IBD Meetup, and you can join the group and our email list, and we'll be sending you out emails for future events. It's a really, really quick form to fill out. Takes about 2 minutes if you want to submit a trade. I encourage you to do so. We're looking forward to giving people feedback at the meeting. So our quote of the week to wrap up is from Richard Wyckoff. Successful tape reading is a study of force. It requires the ability to judge which side has the greatest pulling power, and one must have the courage to go with that side. Currently, the intermediate trend is still up. We're in a short-term pullback that may happen over a couple of weeks, but the intermediate trend is up. That's the general market update for August 4th, 2023. And here's where you can find me on social media. We'll see you on the next general market update.